Bitcoin is worth over $1 trillion not because it finally worked, but because institutions finally believe they understand it. The Federal Reserve just confirmed that lowering interest rates makes Bitcoin more attractive as money searches for yield, yet the same institutions buying Bitcoin today are quietly constructing the very conditions that make long-term profits mathematically harder, not easier, at current adoption rates. This discussion is for educational and analytical purposes only, and does not constitute financial advice. By January 2025, Bitcoin ETFs had attracted over $21 billion in net inflows. BlackRock's IBIT alone controls nearly $100 billion in assets, making it one of the fastest adopted financial products in history. Wall Street now drives Bitcoin's price formation as much as crypto-native activity. The narrative appears complete. Institutional adoption validates Bitcoin as digital gold, regulatory clarity removes uncertainty, and corporate treasuries allocate capital accordingly. That story feels finished. It isn't. But the numbers behind this adoption story reveal something markets haven't processed yet. When OpenAI's CEO admits that, in a very different industry, their $200 monthly subscription loses money on every customer, that's a business model problem. When MicroStrategy builds a $60 billion Bitcoin position by continuously issuing debt and equity to buy more Bitcoin, that's a different kind of problem entirely. The success metric increasingly shifts away from traditional profitability. It's how long the mechanism can sustain itself. The institutional Bitcoin story rests on a simple premise. Scarcity plus demand equals higher prices. Fixed supply of 21 million coins meets unlimited fiat currency creation. Mathematical inevitability drives adoption. Every pension fund, endowment, and corporate treasury eventually allocates 2 to 3% to Bitcoin. That represents $3 to $4 trillion in potential demand flowing into an asset with a current market cap of roughly $2 trillion. But if that allocation becomes structurally harder to maintain as Bitcoin succeeds, then the entire inevitability narrative breaks. Not emotionally, but mathematically. This calculation assumes the cost of maintaining that allocation remains manageable. It assumes the infrastructure supporting Bitcoin scales efficiently. It assumes the energy and computational requirements don't create their own constraints. Most importantly, it assumes the same monetary conditions that make Bitcoin attractive today will persist as adoption scales. That last assumption is doing far more work than most investors realize. And the reason this hasn't been reflected in price yet is not what most people assume. The visible system tells a compelling story. In April 2024, Bitcoin's halving reduced mining rewards from 6.25 to 3.125 coins per block. Historical patterns suggest Bitcoin sees its strongest rallies 12 to 18 months post-halving. The April event occurred with Bitcoin trading around $64,000. By mid-2025, it had risen 31%. Modest by previous halving cycles, but occurring in a fundamentally different market environment. Institutional flows provide the foundation. BlackRock's Exhibit ETF holds 61% market share among Bitcoin ETFs. Weekly institutional flows reach $1.9 billion. These aren't sentiment-driven retail purchases, they're persistent, long-duration capital allocations from entities that measure performance over decades. The liquidity profile has shifted from volatile speculation to steady accumulation. MicroStrategy exemplifies this new model. The company holds over 670,000 Bitcoin worth more than $60 billion. CEO Phong Le describes it as a Bitcoin treasury company, rather than a software vendor. The strategy creates what they call a procyclical leverage flywheel. Rising Bitcoin prices boost the company's market cap. The gap between Bitcoin's monetary premium and its utility as a payment system widens. If Bitcoin's monetary role expands faster than its ability to settle value at predictable cost, then institutional adoption stops being a tailwind and starts becoming a structural constraint. Mining economics reveal deeper structural tensions. Bitcoin security depends on miners who earn revenue from transaction fees and block rewards. The halving reduced block rewards by 50%. Transaction fees must compensate for this reduction, or mining becomes unprofitable for marginal operators. Lower mining participation theoretically reduces network security, though Bitcoin's difficulty adjustment mechanism maintains block production every 10 minutes, regardless of participation levels. The energy requirements scale linearly with price and adoption. Higher Bitcoin prices make mining more profitable, attracting additional computational power. More computational power requires more energy. If you're interested in understanding markets beyond headlines, before their internal math becomes visible, this channel focuses on exactly that. The regulatory environment supports continued adoption. Congress passed the Genius Act in July 2025, providing comprehensive crypto regulation. Federal stablecoin legislation established clear jurisdictional boundaries. The United States prohibited retail central bank digital currencies, positioning itself as the only major economy to explicitly reject CBDCs. Dollar-backed stablecoins strengthen rather than compete with the dollar's global role. This is the part most people understand. The part that actually changes the outcome begins where this logic quietly breaks. The infrastructure supporting this adoption operates under constraints that become binding as scale increases. Bitcoin's network processes approximately 7 transactions per second. Layer 2 solutions like Lightning Network provide scaling, but require additional complexity and capital commitments. As institutional adoption grows, the gap between Bitcoin's monetary premium and its utility as a payment system widens. If Bitcoin's monetary role expands faster than its ability to settle value at predictable cost, then institutional adoption stops being a tailwind and starts becoming a structural constraint. Mining economics reveal deeper structural tensions. Bitcoin's security depends on miners who earn revenue from transaction fees and block rewards. The halving reduced block rewards by 50%. Transaction fees must compensate for this reduction, or mining becomes unprofitable for marginal operators. Lower mining participation theoretically reduces network security, though Bitcoin's difficulty adjustment mechanism maintains block production every 10 minutes, regardless of participation levels. The energy requirements scale linearly with price and adoption. Higher Bitcoin prices make mining more profitable, attracting additional computational power. More computational power requires more energy. The network currently consumes approximately 150 terawatt-hours annually, equivalent to Argentina's total energy consumption. Doubling Bitcoin's price doesn't double energy consumption immediately, but it makes previously uneconomical mining operations profitable. MicroStrategy's flywheel strategy works in both directions. Rising Bitcoin prices enable additional capital raising and purchases. Falling prices create the opposite pressure. The company's debt obligations remain constant regardless of Bitcoin's price. If Bitcoin's price stagnates or declines for extended periods, the leverage that amplified gains becomes a constraint. The company must service debt payments from software revenue or sell Bitcoin, potentially at unfavorable prices. Corporate treasury allocation faces similar dynamics at scale. A 3% Bitcoin allocation seems manageable when Bitcoin represents a small portion of total institutional assets. But if Bitcoin appreciates significantly, that 3% becomes 10 or 15% through price appreciation alone. Fiduciary responsibility requires rebalancing, which means selling Bitcoin to maintain target allocations. Success creates selling pressure. The Federal Reserve's monetary policy operates on cycles. Current rate cuts support Bitcoin demand by making alternatives less attractive. But monetary policy responds to economic conditions. If inflation resurges or economic growth accelerates beyond the Fed's comfort zone, rates rise again. Higher rates make cash and bonds more competitive with Bitcoin. The same monetary conditions that supported Bitcoin's rise can reverse. Institutional adoption creates its own constraints through regulation and compliance. Bitcoin ETFs must maintain reserves, provide liquidity, and meet redemption requests. During periods of significant outflows, ETF operators must sell underlying Bitcoin regardless of price conditions. The permanent bid from institutional flows can become a permanent offer during market stress. If institutional demand can reverse mechanically, without any change in belief, then price stability depends less on conviction and more on flow timing. The same mechanism that stabilizes price on the way up can destabilize it on the way down. On the surface, everything still appears to make sense. By this point, the pattern is clear. The same forces validating Bitcoin's adoption are also narrowing the system's tolerance for stress. This is where the analysis stops being about belief and starts becoming about math. Each of these systems behaves rationally in isolation, which is exactly why the pressure compounds. Mining responds to price. Institutions rebalance to policy limits. ETFs redeem mechanically. Monetary conditions cycle as they always have. The pressure emerges only when all of them activate at once. Not because something breaks, but because nothing can pause. The system doesn't fail here, it tightens. Nothing breaks all at once. pressure accumulates across systems that were never designed to absorb it simultaneously. These constraints don't invalidate Bitcoin's role as a store of value or eliminate institutional demand. They create mathematical pressure that builds gradually, then suddenly becomes binding. The same adoption that validates Bitcoin's monetary premium simultaneously creates the infrastructure costs and energy requirements that make that premium increasingly expensive to maintain. Markets continue pricing Bitcoin as if scale brings efficiency. In reality, scale brings complexity. Each new institutional participant adds operational overhead. Each price increase attracts energy consumption that compounds exponentially. Each corporate treasury allocation creates rebalancing pressure that activates during success, not failure. The Federal Reserve's monetary policy provides the timing mechanism. Current rate cuts support Bitcoin demand by making cash alternatives less attractive. But monetary cycles reverse. When rates rise again, institutional portfolios face immediate rebalancing requirements. The same leverage that amplified Bitcoin's rise reverses direction. Bitcoin's price reflects institutional confidence in continued adoption. That confidence remains justified by regulatory clarity, corporate acceptance, and sovereign interest. But confidence and mathematics operate on different timelines. The structural pressures accumulating today don't require immediate resolution. They require acknowledgement. MicroStrategy's flywheel strategy works until capital markets tighten. Corporate treasury allocations work until rebalancing requirements activate. ETF flows work until redemption pressure exceeds inflow momentum. Energy scaling works until geographic limits bind. Each mechanism functions independently until external conditions change. The mispricing isn't Bitcoin's future, it's the assumption that success is free. This creates a timing gap between institutional adoption and structural constraint recognition. Confidence remains high because the constraints haven't activated yet, but mathematical pressure builds regardless of market sentiment. The gap between expectation and operational reality widens as adoption accelerates. Bitcoin trades as digital gold. The infrastructure supporting that narrative operates more like industrial equipment. Industrial equipment requires maintenance, energy, and operational complexity that scales with utilization. The monetary premium and the operational costs both increase, but on different trajectories. This is what remains unpriced. For now, reality moves first, price follows later.